What's happening, everybody? It's the Mortgage King, and of course I'm doing another video so that the masses can be educated with mortgages and kind of defend themselves more or less. Still want you to double check everything that I say with your preferred mortgage banker, mortgage broker, mortgage professional, mortgage loan officer, whoever it is that you're getting your mortgage from for your property purchase. I'm not going to say home purchase because there's primary homes and investment properties, so I'm just going to say property purchase. But today I'm actually doing a bank statement only loan, which falls into the non-QM category, and so I wanted to make a video regarding non-QM loans so that you guys can know what's out there, what is it, and how they work. Hopefully I can touch on all those topics today. So a non-QM loan is what they call a non-qualified mortgage. Now, typically when someone hears non-qualified mortgage, they panic and they're like, what's going on? Why isn't this mortgage going to qualify? All that really means is that it's non-conforming. It doesn't conform to the guidelines of a, how do I word this correctly? It doesn't conform to the, how do I word this correctly so that it's in layman's terms? Because I know exactly what it is. It doesn't conform to Fannie Mae and Freddie Mac. But how would I word that so that you can understand? It doesn't conform to the guidelines of your traditional conventional loan, which is governed by Fannie Mae and Freddie Mac. When you typically hear about a first-time buyer program, and again, that term is used loosely, they're most likely speaking in regards to a conventional loan governed by Fannie Mae and Freddie Mac. These are your 5 to 3% down loans, homes that you actually intend to live in, things of that nature. They have their own guidelines. And once your file is a little bit less untraditional and it doesn't conform to those guidelines, then you would look into a non-QM loan. It's still a conventional loan, but it doesn't conform to those guidelines of a traditional conventional loan. And so I hope that didn't lose you guys. So in a nutshell, let's say, for example, to give you guys an example, if you're applying for a conventional loan and you are, we'll just use self-employed because this is the most common reason why someone would go to a non-QM loan, is for them being self-employed. If you're self-employed and you're using a non-QM and you're trying to apply for a conventional mortgage, they're going to want to see and analyze your income according to your tax returns for the past 2 years. Now, typically, if you're self-employed, of course, we're talking general, your CPA or whoever it is that filed your taxes is going to report to the IRS write-offs, or what we call expenses. And for example, if you're making $1 million a year, but your CPA or whoever's filing your taxes reported expenses in the amount of $999,000, then at the end of your expenses versus your gross receipts, it looks like you netted $1. And so when you show your tax returns to a conventional loan underwriter, whether it's through Fannie Mae or Freddie Mac, once you submit that, they're going to say, hey, this guy only made $1 last year. Most of the time, that's not the case. Most of the time, that's just how you filed your taxes for tax purposes. But when you went to apply for a mortgage, that's what it looks like you made, because your taxes, it's a financial instrument. It looks, this is something that you've used to report your income. And so when an underwriter sees that, they're saying, hey, this guy only made $1, or whatever the case is. That's just the example. Now, if that's your reason for not being able to go through a conventional loan, if you wanted to use a conventional loan, you're probably going to have to show less expenses. You're going to have to tell your CPA, hey man, I'm applying for a mortgage. Last time I applied, they said I only made $1. Could you somehow do this to where it doesn't look like I just made $1? And your CPA might tell you, I have to use the word might. This is a very delicate subject here. Make sure I don't get in trouble. Again, this is all for entertainment purposes. So your CPA is going to say, okay, I'm going to do less expenses. But when you report less expenses, now you go back to Uncle Sam, and Uncle Sam is going to tell you, hey man, you got to cough up some money. So there's kind of like a no win-win. And most of the time, it's a lot of money you got to cough up, especially if you make $1 million. You're in a different tax bracket. You got to give Uncle Sam a big piece of that. So long story short, what most people would prefer is they'll say, hey, mortgage loan officer, is there any other program that I can use that I don't have to show my taxes? And then now you're in the non-QM sector. Now you're in the non-conforming, we'll call it non-conforming so that the masses doesn't get scared. They're non-qualified mortgages. It's still a conventional loan, except these underwriters aren't going to use your tax returns to determine your income. What they're going to use is something untraditional. Like they're going to collect 12 months of bank statements or 24 months of bank statements, do an income calculation just based on the deposits that are into your bank statements. That's the way they're going to calculate it. Now, because they're not calculating your income the traditional way through your tax returns, your file, it is more riskier for the investors on the secondary market. So you can expect your interest rate to be higher than what you would get on a regular conforming conventional loan. That's just something to expect when you're using a non-QM mortgage. You might be at a barbecue and your cousin used a conventional loan and said, yeah, I got a 6% interest rate, and you're in the middle of the buying process and you say, hold on, but my loan officer is giving me a 7.5. Why is that? It's because you're more riskier to the investors. You're using non-traditional income calculation sources. And so again, your interest rate is tied to your risk, right? So the more riskier the file looks, the higher your interest rate is going to be. But in the grand scheme of things, if you ask me, it's still a great deal because as you're not required to file. How do I say this without getting in trouble? It would be better to put your money into the bricks than it would be to give it away, so to speak. Hope you guys follow me on that one. So that would be another way. Another way is, what if, hey, I don't want to show my bank statements for whatever reason for 12 months or 24 months. Is there any other program? These non-QM loans have tons of different programs that you can use to get qualified without using traditional ways. Now, of course, there's got to be a what's this word I'm looking for? There's got to be, I can't think of it right now. But there's got to be a different, what's this word? Come on, Gio. There's got to be compensating factors. Because you're not using traditional ways of getting approved, something has to compensate for that. And so typically it's in the form of also a higher down payment. So these programs in non-QM typically start at 10% down, and depending on the program, depending on your scenario, they can go up to 25% down. So they take you out of that category of 5 to 3% down or anything of that. Now you can't put 9% down. They start at 10% down and go up to 25% down. So that's what compensates for the risk. Also, when you go the non-QM route, typically higher credit scores are required. You can't go in like a regular conventional loan with a 620 credit score, which I still don't recommend you at any point in time, no matter what loan program you're using. Don't come in with the minimum credit score if you can get it higher. But needless to say, that's something that also needs to compensate. So because you're not using traditional ways of getting approved, you're using a non-traditional way, they're going to want to see a higher credit score to compensate for not qualifying you traditionally. And so, yeah, there's a ton of different programs. You have your regular, you can also use 2 years full doc. Let's say if you're getting a jumbo loan. A jumbo loan is a non-QM product. What's a jumbo loan? That's when you're buying a property that you intend to live in, that the sales price, or what we call the loan amount, is higher than what Fannie Mae, your regular conventional loans, allow. Your regular conventional loans have a loan limit. I believe it's right now, they just went up for the year of 2024 to about 747. Don't quote me on that. It's a simple Google search. But every year they're changing it to something higher because of inflation, obviously. So they want to keep up with the market. Right now they're capped at about 747. Again, Google that. But once your loan amount goes higher than that, now you're in a section called a jumbo loan. And a jumbo loan is a non-QM mortgage. So there's tons of different options. You got your regular full doc, what they call a full documentation, where they're going to check your entire income source. So if you're doing a jumbo loan but you're a W-2 employee, you're going to do a 2-year full doc. That's typically your best route. You also have your 1-year full doc, which is full documentation, tax returns, pay stubs, everything that you get, they're going to want to review that. If for whatever reason you can't, you also have your bank statement loan program, which is the one that I was just talking to you about, which I'm doing now. I'm getting the clients 12 months of bank statements, doing a calculation of that. Whatever the income comes in at, we're going to hit them with 50% of expenses. So typically half of what we calculate is used for income. It could be less if we get the CPA to help us out with that. You also got your 1-year or 2-year profit and loss statement. CPA can help us with that too, where they just make a profit and loss statement, and your income is determined based off of what the profit and loss determines, right? So it's not anything that, and it doesn't have to be like, what's this word? It doesn't have to be like verified or audited or anything like that. It's just a CPA letter with your CPA's signature verifying and saying, hey, this is his current year-to-date profit and loss, or 1-year profit and loss. For a non-QM loan, you also have asset utilization, which is a good one that we use. We have our written verifications of employment. If you don't want to submit anything for whatever reason, and you just want them to calculate your income based on the lender reaching out to your employer and verifying your income that way, that's another way to do it. What else is available? WVOE. What else is available in non-QM? Non-QM has a ton of options. You also have your 1099 option. So if you don't want to show your tax returns or whatever the case is, you can just say, hey, look, this is how much I made in whatever year, the last 2 years or the last year. This is how much I made according to my 1099. That's another program that's readily available for people who have non-traditional income. And then of course you have for investors, the DSCR, the debt service ratio. I forget what the exact acronyms stand for, but it's debt service. And so that's for more investors. It's not for a primary home, but it does fall under because Fannie Mae and Freddie Mac conventional do offer purchases for investments. That's typically not their forte. They don't like having too much portfolios with investments, but they do offer it, and that's what gives you the DSCR loan. But that's what non-QM is. Non-QM is a non-qualified mortgage, or a loan that doesn't conform to traditional underwriting and through loans going through Fannie Mae and Freddie Mac. So a non-QM loan, don't forget this, it's nothing to be scared about. A non-QM mortgage is a mortgage that doesn't conform to the guidelines of Fannie Mae and Freddie Mac traditionally. Now there's still conventional loans, they just don't conform to the Fannie Mae and Freddie Mac guidelines. And they do use compensating factors to compensate for the risk associated with not getting qualified traditionally, right? Higher credit scores, higher down payments, things of that nature. But they're very good loans. We use them all the time. We get people qualified with them all the time. And it's a good way to get approved without having to go the traditional route. So that's my 2 cents. I hope you guys find this information of value. If you thought this video was a little confusing, make sure to contact me, and maybe for your scenario, I can answer a few questions. It's the Mortgage King, Giovanni Mirabal, so you know who said it.